Let's start by talking about some profitability ratios. And the first one is gross profit margin. And as you can see from the slide, it's calculated as your gross profit divided by net sales. So we've taken two numbers from the income statement for this one. And net sales just means your sales net of things like trade discounts, bulk purchases, taking account for returns, things like that. And this is why this metric is important, because gross profit is really what's left over after you cover direct materials and direct labor costs, or COGS, which is cost of goods sold. So the amount of money left over needs to be enough to also cover any additional expenses such as overheads, advertising, even taxes, things like that. And as an example of how to interpret this ratio, gross margin of, say, 20% means that after every dollar of sales, you have 20 cents left over after paying for those direct materials and labor. And as we said, you need to use that 20 cents out of every dollar to pay for things like advertising and other overheads, and hopefully still have something left over for profit. Remember too, when you see a gross margin number, it's not talking about volume necessarily, at least in terms of units. So you could have, let's say, a 30% gross margin, but you've only sold 2 units. Let's talk about return on sales. This is an indicator of the overall profit of the company, and it's calculated by taking your net profit after taxes divided by your net sales. So as an example of interpreting this ratio, if you had an ROS of 7%, that would mean that you've got 7 cents in profit after taxes for every dollar of revenue. Is higher better? Well, maybe, but what if you had a high profit margin because you have low expenses in an area that you shouldn't have low expenses? What if you're not paying market average salaries? What if you're not investing in research and development for the future? What if your prices are too high relative to your expenses and customers are going to stop buying from you next year? So your high profit margin in that case might be unsustainable. Return on assets shows how the assets of the business are generating profit, and it's calculated again as net profit after taxes, but this time divided by total assets. So as an example, if you had an ROA of 5%, it means that you're generating 5 cents in net profit after taxes for every dollar of total assets that you've got. And total assets includes cash, invested assets, capital, buildings that you might own, things like that. And generally, you want this number to be higher rather than lower. But again, is higher always better? Not necessarily. What if you're a construction company, let's say, and you're overworking your assets, your machines and your tools, but you still have a high ROA? That could actually be a problem down the road because you may have unexpected maintenance or replacement costs that come up that make having that high ROA a Pyrrhic victory. And this is a case we need to be wary too of comparing ratios across industry where they might make more or less sense. Comparing ROA between a construction company, from our example, with an insurance company wouldn't make sense. These are two very different types of businesses. And let's talk about another profitability ratio, return on equity. And this ratio shows how the capital contributed by the shareholders and also capital that is retained in the business as opposed to being paid out as a dividend is being used to generate profit. And this one is a pretty important metric for any company, and it's calculated net profit after taxes divided by total shareholders' equity. So if you had an ROE of 12%, you're generating 12 cents of net profit after taxes for every dollar of total equity that the owners of the company have invested in the business and retained in the business instead of taking out as a distribution or a dividend. EBITDA is earnings before interest, taxes, depreciation, and amortization. So it's a subtotal or a subset of profit before taking those things out. And it's often called operating profit. And it's getting to the profitability of the core operations of the business before you take out corporate level overheads like interest that comes out of your capital structure and financial strategy, or taxes. Depreciation would be obviously another thing that's at a very corporate level based on your tangible assets, or amortization of intangible assets. So it's getting to the fundamental profitability of the company. And EBITDA gets a lot of attention from stakeholders because it's highlighting that profit-generating capability of the company's operations.